Welcome to this session on economic environment and business strategy. Today, we shift our focus to a critical dimension of macroeconomics, the external sector of the economy. So, in an increasingly globalized world, no country operates in isolation. So, trade flows, capital movements, and exchange rate dynamics shape the environment in which businesses make strategic decisions. For firms operating in or engaging with global markets, understanding these external forces is not optional, in fact, is essential. So, in this session, our focus will be on balance of payments, a comprehensive accounting framework that captures all the economic transaction between a country to the rest of the world. The BOP is not just a statistical tool, it offers deep insights into a nation's trade patterns and capital flows and economic growth. So, more specifically, in this session, we will examine how these components are structured and then what drives imbalances in balance of payments. And then by the end of this lecture, you will be equipped to interpret key indicators from the external sector and connect them to strategic challenges and opportunity faced by businesses operating in India and beyond. So, let's begin by understanding the structure and logic of balance of payments. So, to begin with, how a country is related to the rest of the world. The first one is that there will be trade in goods and services. To begin with, one of the component of trade in goods and services is the export. That means some of a country's production is exported to foreign countries, and that by increasing the demand for domestically produced goods and services. So, as we have seen in the previous session that in the circular flow, when we are discussing the circular flow, we found that we have identified that export is an injection to the circular flow of income. So, that is the export. Then the other component is import. Import means some goods are consumed or invested at home which are produced abroad, and thereby it was we receive it by importing from abroad, and this also we have identified this is a leakage from the circular flow of income. As I have mentioned, a country is related to the rest of the world, one in terms of trade in goods and services that we have already seen, one in terms of export and other in terms of import. And another way in which a country is related to the rest of the world is through the finance route. That means portfolio managers shop the world for the most attractive yield. That means as international investors ship their assets around the world, they link assets markets here and abroad, and which would affect their income, exchange rates, and the ability of monetary policy to affect interest rates. So, in short, Indian residents, for instance, Indian residents can hold Indian assets and or assets in foreign countries. So, this is the two routes through which a country is related to the connected to the rest of the world. So, these links have been documented or have been captured through the balance of payment record. So, balance of payments is an official record of the transaction. It's a record of the transaction of the residents of a country with the rest of the world. So, mainly there are two accounts. One is called current account. It records all trade in goods and services as well as transfer payments. So, in short, the current account is in general it is called as balance of trade account. In short, it has been called as BOT account. And the second one is called capital and finance account, but often we call it capital account, but it also includes finance account as well. It records purchases and sales of assets such as stocks, bonds, and land. by foreigners in India and Indians abroad. So these are the two main components. So to understand this balance of payment, there is some intuitive rule for determining credits and debits. So coming to the credit transaction in the balance of payment account, the credit transactions give rise to conceptual inflows or sources of foreign exchange. So the purchases of goods and services and assets by foreign residents from domestic residents, that mainly exports, are credits because they are a source of foreign exchange. Here, in addition to export, these two are mainly export, and these assets a kind of capital inflow, maybe even giving some foreigners giving a loan to our country, that's also become a capital inflow, but that will be recorded on the credit transaction side, because mainly because they are a source of foreign exchange. Then coming to the debit transaction, it gives rise to conceptual outflows or uses of foreign exchange. So mainly the purchases of goods and services. So these are the imports, goods and services, plus assets by domestic residents from foreign residents are debits because they cause an outflow of foreign exchange. So what you can see here is that this export should be related mainly to the goods and services. Similarly, this import should be related mainly to the goods and services part. Assets that actually will later on will connect with the financial flow or capital inflow or capital outflow. Moving further, an important rule in the balance of payment account is that the external accounts must balance. So that means a central point of any international payment is straightforward. That means individuals and firms must pay for what they buy abroad. So if a person spends more than his or her income, his or her deficit must be financed by either selling or borrowing abroad. So similarly, if a country runs a deficit in its current account, the deficit needs to be financed by selling assets or borrowing abroad. So in short, here the selling or borrowing implies the country is running a capital account surplus. Any current account deficit is of necessity financed by an offsetting capital inflow in it. That means suppose a country has for example 1 billion, just take a simple example that there is a 1 billion of current account deficit. So for example, current account deficit is for example 1 billion. That means here export is less than import by 1 billion. So that means if you translate this one to a layman's language, that means we are exporting less than what we are importing. That means we are importing means we are consuming more than that we are able to give back. That means by 1 billion, in this example we have a shortage, the deficit of 1 billion. That means we are importing 1 billion excess of our export. That means how do we pay for this? Because when we are importing goods and services, we must make a payment. That means the rule here I have written in the beginning, individuals and firms must pay for what they buy abroad, right? They must pay. So that means this 1 billion they need to pay. In order to make the payment for this excess 1 billion, either they need to sell their assets, for example gold or any other assets abroad, or they should borrow from abroad. Then only either of these or including a mix of both, then only they can finance this 1 billion. That means if there is a 1 billion shortage is there, that means in the current account there is a 1 billion of deficit is there. That means if there is a 1 billion deficit in current account, then we need to have a 1 billion of surplus, 1 billion of surplus in the capital account. That means the money that we are getting from abroad by selling assets like gold or borrowing from abroad. That means current account plus capital account equal to 0. That means here I mentioned that minus 1 billion billion. So that has to be paid by either by buying, selling an assets or borrowing. So that means here plus 1 billion. That means when we are borrowing, that means in the balance of payment it will be credited. This is what I meant in the previous slide. That means the debit and credit part. So this is when we are borrowing from abroad or selling our assets abroad, and that money will be credited to the balance of payment account. So let's now move ahead. Let's go through one by one what this current account and capital account means. So we are following the definition as per the international standard. So first, the trade balance. Trade balance means when the export equal import, then we can see there is a trade balance. That means the value of goods and services that Indian residents export less those that they import. So we can say there is a balance of trade. There is no deficit or no surplus. That means is equal. So when balance of trade deficit means our import is greater than export, and similarly balance of surplus means our export is greater than import. So then the second component is actually mainly the primary income balance. That means here in the trade balance mainly I meant the export and import of goods and services, and here the primary income balance means mainly the income from abroad, the factory income from abroad. That means net income from abroad, the income that Indian residents earn from abroad less than they pay to the rest of the world for working. That means in the terms of wages, and from financial market investment you will get interest income and dividends. So that means prime net income from abroad means what Indians earn from abroad minus what foreigners earn in our domestic territory of our country. So that is recorded as primary income balance. Then there are secondary income balance. Secondary income balance not because of any productive activity, because for example foreign aid, remittance, gifts, grants. So it consists of two parts. One is the income that Indian residents earn from less than they pay to the rest of the world from the government. That means mainly tax payments and the refunds. And then coming in second part is the current transfers. These are the transactions between Indian residents and the rest of the world, where one party provides something to be consumed by another party without receiving anything in return. For example, emergency food aid or any grant or gift to meet the natural calamities or any other emergency, or that is just a current transfer not given for any productive services. And then moving to the second component, that is the capital account. So the capital account, it consists mainly the capital transfers where one party has transferred ownership of something to another party without receiving anything in return, just like current transfers which I mentioned in the previous slide. Here capital transfer, this also not for anything specific. That means somebody is getting this money for receiving anything in return. This includes conditional grants for specific capital projects. For example, a foreign aid project to build roads and other infrastructure, and similarly debt forgiveness. And then another component is non-financial non-produce assets transfer. These are mainly intangible assets. For example, brand names, copyrights, right to use land or water for mining or fishing. So this includes non-financial non-produce asset transfer. Then we have another major component that is called financial account. It involves a change of ownership of the country's assets or liabilities with the rest of the world. So shortly about this financial account, let us go in depth about the component of financial account. It involves a change of ownership of country's assets or liabilities with the rest of the world. So the main component in the financial account is direct investment. Direct investment means financial transaction related to long-term capital investment in a business. So I have given some examples here: purchase of machinery, building or factories. We call it as direct investment or foreign direct investment. That means, in short, you might have heard that FDI means foreign direct investment, and it has been recorded in the financial account under the direct investment heading. Then we have portfolio investment. Portfolio investment means instead of foreign entities directly coming and investing in India, instead of that, what they will do, that they will purchase equity or debt instrument. They will either invest in the stock market, or they will buy the IPO, initial public offering, or they will buy from the secondary market, stock market, or they will be buying government issued bond, or government issued or corporation issued bond. So that means they are investing in India, but they are not directly coming here, directly setting factories, or directly engaged in the production. So this means the other component, that the portfolio investment, instead of directly engaging in the capital investment, they purchase equity or debt instrument in a business. So in short, in contrast to direct investment, portfolio investment occurs when the investor doesn't have an influence in the operation of business. Then we have the third component, that is called financial derivative. That is the purchase of sale of financial derivative. So they will be investing in option market or spot market. They will be investing mainly in the derivative market. That means the financial contracts between two parties where the value is derived from another financial instrument, such as a bond, share, or market index. So in addition to this, there are reserve assets. These are mainly held by the central bank. It means the purchases or sale of reserve assets held by the Reserve Bank. In India's case, is the Reserve Bank of India. So these reserves are assets controlled by the Reserve Bank to meet policy objectives such as the intervention in the foreign exchange market, and to assist Indian government in meeting its commitments to the IMF. So the reserve assets, just to repeat about the reserve asset, these are the transactions done mainly by the Reserve Bank of India, and the main objective for doing it is mainly to make intervention in the foreign exchange market, to stabilize, to influence the foreign exchange rate, and also to help the Indian government in meeting the commitment with the IMF, International Monetary Fund. The last component is other investment, and these are the transactions that do not fit into one of the other categories. For example, one example is trade credit, when an importer purchases goods from overseas and doesn't pay for the goods until they are received. So another example is currency and deposits, where money is deposited in or withdrawn from banks across borders, or bank notes or coins are transferred between countries. To summarize this one, put in a little bit summarizing the components of balance of payment. One which I mentioned, under the current account transaction, it includes mainly the purchases of goods and services, that the export and imports. Then the income payment, that the interest and dividend receipts and payments, and transfer payments between countries, gifts or aid. Then the other component is the capital account, the capital or financial account transactions. This mainly the capital outflow when residents invest in foreign assets, and similarly capital flight when money leaves a country quickly, and similarly there is capital inflow, that means when foreigners invest in domestic assets. And in addition to that, there are official reserve account transaction. This is mainly done by the central bank, as I already mentioned. This reflect the changes in the official international reserves. So the reserves include mainly the gold, special drawing rights with the IMF, and reserve position in the IMF and other claims. So note here, the official reserves are accumulated, which means includes not just received in the current period, but accumulated over time. So let us now explore how balance of payments are structured. So as I already now familiar, it has current account and capital and financial account. So coming to the current account, in the balance of payment record, it will be recorded like trade balance. One is called trade balance. That means exports of goods minus imports of goods. Second one is called service balance. That means export of services minus import of services. Then comes income balance, that is primary, which I already mentioned in the previous slide. That is the net compensation of employees and investment income. And the fourth one is net unilateral transfers, that are mainly the secondary income balance. So you can see all these item 1, 2, 3 and 4 is called current account. Then moving to the capital and financial account, the capital account we already discussed, and then the financial account, it will be classified into 3. FDI, that is the direct investment, foreign direct investment, and the second one is portfolio investment, and the third one is other investments such as loans, amortization and financing. Then there are some errors and omission, that is called statistical discrepancy. These are also part of financial accounts. In total, the balance of payment, how is structured in the record is that the CA plus item, the capital account, already you know the A plus B plus C, all these together it will be balance of payment. In short, when we are summarizing this one, we should get this one equal to 0, because current account plus capital account is going to be equal to 0. So I'm showing you an illustrative example of balance of payment account, which all transactions are reported in the credit and which all transactions have been recorded on the debit side. So you can see, for example, here on the credit side, these are straightforward. You can see that these are export of goods and services. So the proceeds that we get from the exports of goods and services, one is goods and second one is services, goods and services. Similarly, income from foreign invest, these are all called, you can see these are all our credit in the balance of payment account. Then you can see the unilateral receipts, that is we are getting from abroad, and similarly the borrowing, the foreign borrowing that we are making from abroad, that actually though is a borrowing, actually borrowing means we owe them, right? But still, but in the balance of payment, because it's a capital inflow, because of that we put it in the credit part. So that means if you are borrowing from abroad, on the capital account is going to show that there is a surplus. Then even the short-term borrowing also becomes a part of credit. And similarly, if you are selling, the sale of gold and other assets, these are all going to become a part of credit. That means this item, you can see clearly item number 6, 7 and 8, 6 and 7 clearly borrowing, but on the balance of payment account, this will be reported as a credit. And similarly, if you are selling assets like gold or any assets that we are having abroad, any building or any other factory or something, this if you are selling, that also become part of our credit. And coming to the debit, you can see that these are all import. For the import, we report everything in the debit side. And the unilateral payment, suppose Indian government is give an aid, foreign aid to African countries and nearby South Asian countries, then what we are going to do, that if you are giving for example aid, a government is simply giving money to the nearby countries, neighboring countries, but then that will be reported as debit in our account. Actually we are paying money, but they actually in fact owe us, but in the balance of payment it will be reported as minus. In fact it is a debit in our account. So then there is long-term lendings, short-term lending to foreign countries and foreign corporations, that will become a debit in our account. Suppose similarly if you are purchasing gold or assets of foreign entities, that also becomes a debit, because for that we are paying from our forex reserve. And similarly errors and omissions, it become positive. This also, for example, these errors and omission, this also become a debit in the account. So this is how the balance of payments account is structured. I'm showing you here how balance of payments are recorded in India's official record. You just go through the economic survey and go through the statistical appendix, and in there actually it's clearly written in the document. You can see the each and every item that's starting with import, export, trade balance, how trade balance is calculated, then the invisibles, then the current account balance, capital account balance. So you go one by one, then it will give you more information, very detailed information about the balance of payment components. And when you submit, you will get lots of insights, what are the components of balance of payment, how is changing over time. So I would strongly urge you to go through the economic survey statistical appendix. In the previous slide, I just mentioned that invisible account. So let us have a quick discussion, conversation on what is meant by invisible account. Actually, is a part of current account. So usually consists of service account and gifts and charities accounts. So it consists of banking and insurance charges. In restaurants is the main components, tourist expenditure and transport charges. In addition, gifts and charities. So IMF includes the following items as invisible transactions. So you can see international transaction of goods including warehousing while in transit and other transit expenses, and travel for reasons of business, education, health and international convention or pleasure, insurance premium and payment of claims, investment income including interest, rents, dividends and profit, miscellaneous services such as advertising, commission, film rental, pension, patent fees, etc., and donations, migrant remittance and legacies, and contractual amortization and depreciation of direct investment. All these components are between countries, the transaction including in all these between countries, that is denoted by the invisible account in this context. So what we have done in this lecture is that we have discussed what is meant by balance of payment. So in that context, we discussed current account and capital accounts, and then we listed out each and every component that is coming under the current account and capital account. And we also shown that current account and capital account must balance as per the balance of payment transaction. Thank you for watching this session and see you in the next session. Thank you.